So this week has been a rough week for Chinese stocks, especially the tech giants and education companies. We've seen the likes of Tencent fall 20% in 1 week and then recover 10% of its losses. Likewise, Alibaba was down 16% for the week and recovered some of its losses too. Education companies such as Tao Education lost 70% of their market cap in 1 week, just 1 week. And so why was this? Why did all of this happen? Well, firstly, on Monday, we had an announcement from the CCP that they would ban domestic and private education companies from making profits, raising capital, or listing on stock exchanges worldwide, and would prevent them from accepting any form of foreign investment. The concern here for China and the CCP is that companies or investors are looking to profit from their learning subjects, potentially tarnishing the core focus of the learning aspect. Now, needless to say, this was a gut-wrenching announcement for any investors in these companies as they are listed on the New York Stock Exchange. We're talking about Tao Education and New Oriental here. These are for-profit organizations, obviously, whose industries had been booming lately, as demonstrated in their stock price performance. As you can see, an 8-fold return in the past 5 years, and then they've lost around 90% of their market cap in just a 6-month period. And then if this wasn't enough, to create further bad sentiment around investing in China after last year's Alibaba situation and the recent Didi scandal, then investors were met with another low blow, that China's internet regulator was set to start a 6-month rectification program aimed to rectify the anti-competitive and monopolistic behaviors that big tech companies employ in China, as well as review the ways in which they consume and use user data. One behavior that was being highlighted was link blocking, which companies like Tencent employ on their super app WeChat to prevent users using their rivals' products and services. So this sort of behavior is not necessarily seen to benefit consumers, as it creates a hard line and tall wall between the rival ecosystems such as Alibaba and Tencent, and they offer the same consumer products, so it's seen as anti-competitive. That is the core aim of this crackdown, to eliminate behaviors that do not benefit the consumer or users of the platform, but instead only benefit the company. Now, we get an idea that Tencent is the main target here, that Tencent is the company who's being hit most by this 6-month rectification program. Although it could change, it seems like Tencent's behaviors are the ones being targeted for now. And we know this because as of Tuesday, they announced that they were suspending user registrations, new user registrations for their WeChat platform until they could comply with all relevant laws and regulations. And registrations for new users would only be restored once this compliance is complete, and that's expected to be sometime in August. And so this, in theory, should have a fundamental impact on Tencent, but with their 1.4 billion users on WeChat, you start to think, new user growth isn't necessarily a concern at this point, especially if it's only going to be for a month or two until they can upgrade their security processes, but still a low blow for Tencent investors nonetheless. And so obviously, this news has really hit the markets like true collateral damage. Even before this, we had bad sentiment around Chinese stocks because of the Didi, Ant Group and Alibaba issues. And we have people like Jim Cramer, market commentators, who are saying that for international investors, China stocks are off limits. You can't own these stocks, is what he says. Of course, this is the same Jim Cramer that 2 weeks ago was telling us to buy as many Didi shares as we possibly can at IPO. And not long ago, that he's pounding the table for investors to buy Alibaba. Now, in fairness, news has arisen since then that may have reasonably changed his mind, but I wouldn't be surprised if a year from now, he's again pounding the table for people to buy Chinese stocks like he was very recently. That's just how Jim Cramer and his kind of people, those kind of investors, operate. He's a fast money hedge fund guy, and he ran a trading style hedge fund for a long time. He talks about the next quarter and not the next decade. So we have to remember, as long-term investors, when we see this, people like Jim Cramer are reflective of that group of investors. And unfortunately, these are a powerful group. The powerful fast money hedge funds, they are able to move the markets and prices on a daily, weekly, monthly basis because of the amount of money they can flow in and out of a stock. But for context, I also remember when Jim Cramer, or those people, were telling us that we can't buy bank stocks. Interest rates are at an all-time low. This was back in from July to October 2020 when they were really being beaten down. Now, if you take Wells Fargo as an example, which was one of the most beaten down bank stocks and didn't really have that investment banking or trading arm to save it, they were telling us not to buy those stocks because the next quarter is going to be ugly. Now, if you did the exact opposite to them and saw that they were selling at low single-digit PEs and decided to buy them, well, you would have had a 90% plus return in less than a year. And not to act smug, but that's exactly what I did. And of course, when the stock started running back up with no real change in the business, people like Jim Cramer were beating the drum again for us to buy some of these low PE bank stocks that were part of the turnaround story. Now, I'm saying all this not to criticize Jim Cramer, but to demonstrate how powerful negative sentiment is in the short term in respect of price fluctuations, but also to demonstrate that sentiment only lasts so long. When fundamentals don't change and prices are irrational, then fundamentals will always prevail, just like we saw in the bank stocks for the past 6 months to a year. And just so you know, I'm hurting bad when it comes to Chinese stocks. To be transparent, I own 3 Chinese stocks currently, Alibaba being my biggest position in the portfolio, and then currently being down 15%, and it's roughly 30% of total. I need to actually update this. And with it being 15% down, obviously that's hurting my current P&L. And I'm actually, believe it or not, adding to this position at below $200 because to me, I don't see anything as cheap and obvious in the market today as Alibaba. And of course, this only works at the moment because I'm comfortable with concentration and don't feel like I have to publish quarterly reports or reasoning to other people, investors, or myself that explains why my positions are down 10% this quarter. So realistically, I don't care. But would I advise being this way? It depends on your risk appetite. But for me, if you contextualize the Alibaba growth potential versus the risk of wiping out our capital through China's legalities, let's say it's a 90% chance of a 3x, which I think it definitely is with Alibaba, and then a 10% chance of losing it all, wiping out your capital. If you've got a 9 in 10 chance of making a 3x in exchange for a 1 in 10 chance of losing it all, then that's a bet you should take. Even if it's more like 80-20 or 70-30, then that's still theoretically a bet you should be taking. For example, if you had a $100 bet, to keep things simple, on average out of the 10 bets, you're going to be making $2,700 and losing $100 once. Again, a bet you should take. It's not quite as simple as that, but if you think about it from that perspective, I think it's quite helpful. Now, Baidu and JD, not as much effect on my portfolio with them being down because they're relatively small and new positions, but I still believe in both of these businesses, maybe not in the same way or same confidence I have as Alibaba, but I believe in China, more importantly, Chinese tech, and I believe in their growth opportunity. So it could well be that I bought these companies too high relative to where they could have been trading at, after that, especially with there being negative sentiment around China. But I'm more interested in looking back in 5 years' time and seeing if I was happy with the price I paid then. By that point, I don't think it will be a factor. And I think the most important thing to look at here is this date invested. Still all in 2021. So really, where the price is right now, I'm not too bothered because it's been in my portfolio for less than a year. So it's hard to really reflect on it at this point. And so what am I doing in the midst of all this? Well, I'm buying more Alibaba. Like I said, I bought more Alibaba at $182. I think that was back on Tuesday. And I will find it hard not to continue adding below $200 per share. And then, like I say, I'll be holding JD and Baidu positions as my long-term thesis is still very much intact. I don't think anything has changed there in terms of what I see the business doing over the next sort of 3 to 5 years. And then lastly, I want to analyze the effects of the latest crackdown on Tencent's WeChat to see if the largest sell-off this stock has had in a decade in terms of the last few months presents a great buying opportunity to start a position. So I'm going to be looking into that a bit more, see if it's a good opportunity to open a position in Tencent because it's a business I would want to own. It's just a case of getting the right price. And now I know this video is more just an update. I haven't really gone into detail around the risks that are associated with holding these Chinese stocks, but I did do a video very recently when the Didi scandal happened that further explained all of the risks associated in holding these Chinese stocks as a foreign investor. So go ahead and check that video out. That should give you some of the explanation that you might need that isn't in this video. So I'll link that down below. Now, of course, there's always a bigger bad sentiment around China. China's always the one that people are more frightened of in owning their stocks. It's not like in the US or in Europe, governments would look at cracking down on the power of big tech companies. Oh wait, they would. June 16th, very recently, we have something come out that says Democrats and Republicans are showing very rare unity in desire to crack down on big tech companies. And we've even got Biden signing an order to crack down on big tech and boost competition across the board. They laid out a case that the biggest tech companies are wielding their power to box out smaller competitors and exploit consumers' personal information. To me, this looks like exactly what the Chinese government is doing to big tech. Not necessarily the education part. I do get that that's a little bit more frightening, but in terms of what they're doing to big tech, it's exactly the same as they're doing in the US now. We also had fines issued in Europe for the likes of Google, Facebook, and Amazon for their data practices and anti-competitive behavior. So it's nothing new. It's not like this is just happening in China, is what I'm trying to get at. But of course, with it being China, with it being the CCP, Communist Party, people are more concerned, and there's a lot more fear that exists within the markets. And I believe that's what's driving down the stock prices to these ridiculous levels. Now, another way to contextualize and just to show that markets always behave irrationally for a fairly sustained period of time. If we look back at Facebook and the Cambridge Analytica scandal, and I've said this in previous videos and used it as a case study of what's happening with, say, Alibaba at the moment. But if we take what happened to them in 2018, Cambridge Analytica scandal, the stock dropped around 40% from its peak, and it was fairly sustained as well. We saw it carry on for a fairly long period of time. It didn't quite get back up to its pre-drop levels until a full year after it had originally dropped. Now, if you would have bought at the lows back then in the Facebook scandal, then you would have made 170% return in less than 3 years. And so that's not to say that this is exactly the same situation, but it's a good case study to look at. A similar situation where there was a lot of fear around this company. Was Facebook going to be broken up? Was Facebook going to be penalized? Would it ever come back from it? And obviously it did. It's a very good company, had strong earnings, strong cash flow, and now they've got a value of over $1 trillion. So we may well see something very similar with Alibaba, with Tencent, and some of the other Chinese companies. We just don't know how long this is going to carry on for at this point. And so that's about it for this video, guys. I'll leave a link to the Patreon and Discord down below so you can get updates on my buys and sells and what I'm doing. I obviously shared on Tuesday that I was going to be buying more of Alibaba and gave my thoughts on the situation. So you can go ahead and check that out. You can get all of the valuation models that I've done previously. You can see my buys and sells. You can see a valuation spreadsheet that tracks all of the stocks we've covered on the channel, what their estimated fair value is, and what they're trading for now, so we can maybe catch some stocks that are undervalued based off of my assumptions. And then you also get access to the Discord community where people are talking every day on different stock market topics. I'll leave a link to that below if you're interested in joining the Patreon. Other than that, if you can like, subscribe, comment, let me know what you think of the recent sell-off in China, and if you think it's safe to invest in China or you think it's just not worth touching. I'd be keen to know down below. I'll see you all in the next video, and as always, good luck with your investments.